Let's bring in Peter Tchir, who's the founder of TF Advisors, and he joins us from New York. Peter, good to have you back on the program. First off, how are you reading the markets? Is this a bit of window dressing to close out the month?
No, I think this is just a kind of the end of the short squeeze. We started seeing it last week. I think the markets have got way too scared that Greece was going to exit, that was going to be imminent, and that was going to be a disaster. People were very concerned about Spain, which I think is still a problem. And then, the whole JP Morgan mess that's gone on, I think we were just very oversold. Every indicator, whether it was RSI or more complicated ones, just really showed oversold. So I think, on any excuse, we were looking for a bit of a bounce. The JP Morgan situation's cleaning up. I think everyone's realizing Greece is such a mess that it's unlikely that they actually leave right away, because no one can tell whether it's bad for Greece, bad for the EU, bad for the ECB. So I think we're going to get this kind of pause where everyone watches that. The only thing that was a little bit surprising, I think, was Bankia looked like they were getting resolved, and it sounds like the ECB is rejecting Spain's plan to bail out Bankia. So I think that's probably causing a little bit of nervousness. And then as you saw today, I guess, or this evening, all of a sudden it looks like China might not be providing as much stimulus as everyone was hoping for.
Yeah, okay, so what does that mean going forward? We saw a 1% bounce overnight, but do you think it's just temporary?
Yeah, I think it's temporary. I keep thinking that we kind of get back to the 1350 level on the S&P, so we maybe have another 1 to 2% worth of gains, and it's going to become, come out of the fact that Greece is starting to back down. I think Greece does not actually want to leave the euro. I think Germany, for all their tough talk, is going to say, whoa, we actually don't want Greece to leave the euro right now, maybe in 3 months or 6 months, but we need to do some planning. So I think we get a bit of good noise out of Greece. I think the JP Morgan situation's calming down. And if Spain can just kind of, keep this Bankia situation under control, we'd probably get a little bit more short covering, a little bit of optimism. We've got the housing number. We either have some hope that we'll get a good non-farm payroll on Friday, or that it's bad enough that the Fed steps in. So we're a little bit in the same boat where everyone's waiting for the ECB or Fed or central bank to step in and provide more liquidity.
And the Chinese central bank
Without that, I think we sell off.
Yeah, you think so? Okay. So what do you think the expectations are and the probabilities are then of QE3 or a continuation of Operation Twist?
I think we're going to get something on the QE3. I think they're going to go something that targets mortgages, because politically they've got to do something that doesn't look like the money's just going to the banks. So if they can say it's targeting mortgages, or maybe even better yet, it targets mortgages originated in 2012, the Fed can say, hey, we're really trying to pump this into the housing. We're trying to bypass the banks. We're not just buying up old inventory. I think all the things are kind of right for it. We're seeing, every inflation indicator has been dropping over the last month or two. Employment, which they watch, has been dropping. And the other thing, they watch very carefully. I don't think they admit it, but they watch the CDS spreads. And ever since the JP Morgan announcement on May 10th, we've seen CDS spreads for the banks creep higher. So Morgan Stanley's back at 450. They were last there kind of at the end of the year. So I think the Fed wants to arrest any kind of issue that might be creeping up in bank lending right away. And
okay,
the
what
closer
about
they wait for the
Facebook
election,
shares? Sorry, I got to talk about Facebook because look at the $29 a piece starting from 38 when it sold shares and listed on the exchange, and that's because people are putting on shorts, and why not when you have such lofty levels?
Yeah, and I think the whole market now is just, it looks like a mess. I think any chance that retail is going to be a little bit more excited about what goes on in the market's probably done. And I think ironically, the weirdest part is, had they priced it at 29, it would probably be trading at 38 today. So I think it just shows that really in this market, it's all about the pain trade, people looking for people in the wrong position and pushing it. Can it go down further from here? Possibly. My guess is we start seeing support at this, $25 level. And it's so, erratic trading. It would not shock me to wake up and all of a sudden we're at 33 or 34 quickly as well.
What are you doing right now in the markets, or what would you advise someone to be doing in this volatile environment?
I actually continue to like U.S. high yield, both on the corporate bond side, but also the bank debt side. I think the bank debt side offers a little bit more safety. For now, I'm a little bit long U.S. I'm actually starting to, go a little bit long Spain versus short Germany. I think we've got one of these things where so much bad news is priced into Spain and so little is priced into Germany that in either way, whether we get some resolution, we see kind of a big short squeeze, or if the problem continues to grow, people will realize Germany's in trouble. So I think we're right at that cusp. We maybe get a little bit more upside, but without serious government intervention or central bank intervention, the next leg is, I think, a pretty serious down leg, and it's going to hit the markets that have been least affected, so U.S. and Germany in particular.
All right, Peter. Thank you so much for your time today, and I hope you had a good Memorial Day weekend. There you go, Peter Tchir there of TF Advisors.